I wonder, though, 4% plus yields for not just the 2-year, but the 10-year. It sure seems attractive to somebody who remembers seeing 1.5% to 2% yields. So can I just buy in right now and lock in those yields, or is there still better yield to come?
Yeah, by the way, not too long ago, right? 2.5 on the chart you just showed. So yes, I think you can buy it. I think what you can expect is to make money right away. In other words, we're not going from 4.19 to 3.19 next week. I think the income you're going to earn and the ability to ease into yields here is good for investors, but it's hard to call a bottom given the traditional buyers haven't shown up.
What exactly then would be the biggest concern that you have? We know what the economic data has been showing. It might be backward looking. We have expectations for what rates are going to be. So if you were to look at the interest rate complex overall, what's the biggest worry that you have? Why could rates still continue to go higher and bond prices cheaper?
I think there's a couple things to worry about. One is obviously the Fed, right? They're on a mission. They want to tighten financial conditions. They don't want a big rally. So you don't have any tailwinds coming for you. They may slow down the pace of tightening, which could be one coming. The other one I think is Japanese rates. I know it sounds a bit odd, but Japanese rates being pegged at 25 basis points, it's getting harder and harder to keep that peg. If that market were to break and volatility increase again, you could get a disorderly move higher in interest rates.
Now, the Treasury side of things is getting focused on quite a bit here. Investors have been seeking yield elsewhere besides the Treasury market. They've found it for the better part of the last decade plus in things like investment grade corporate credit, right? So it's closely linked to Treasury yield moves. And then again, yield hunting in places like high yield, which don't just factor in rates, but also factor in credit risk as well. So are those parts of the market attractive right now?
Listen, I think on a long-term basis, yes, but it's interesting that the higher quality things like investment grade, like high-quality munis, treasuries, mortgages have done worse than high yield. As you say, it's a duration move. So I do think as you're building your income portfolio, you can look at high-yield leverage loans, but the cheaper parts of the curve, the cheaper parts of the market, I think are investment grade, treasuries, mortgages, more traditional, safe, higher duration assets.
Now, as the rate picture evolves, what are your expectations for how the Fed plays things out, so to speak, over the next couple of quarters here? We've heard a number of Fed heads, Fed regional presidents, come out and predict where they think rates are going to stop, maybe where they end up going, where the terminal rate or the ending of this campaign for rate hikes could be. In your mind, what do you think it is?
Listen, I think the Fed has two concerns. The first is terminal rate. So I think that gets to 4.75 or 5. The market took a while to get there. We sniffed it out. The Fed helped us. And I think the market fully gets that. The second part, though, I think is pace. Right. So going 75 basis points a meeting is too fast. It's too much. They've caught up as much as they need to. They're going to get close to that rate by the end of the year. And they have to get the markets ready for a slower pace. They want to do that without convincing the markets they're going to ease or pivot. So they need to stay hawkish and slow down. I think the markets will overreact to that, but I do think it is one of the next big things to watch for.